Welcome to the Deep Dive, where we cut through the noise and really try to unearth those vital insights. August 2025 is shaping up to be a really pivotal month. We're seeing a wave of significant updates, to your federal and state benefits, and alongside that, some pretty critical shifts in how estates are handled. So what exactly do you need to know to navigate all these changes effectively? Let's jump right into most immediate news first. Over 71 million Americans are about to get their Social Security payments. And for many of you receiving Supplemental Security Income, or SSI, you're actually going to see two payments land in your accounts this month. Now, before you get too excited, this isn't some surprise bonus check or anything. It's just because the Labor Day holiday falls on September 1st, so that September SSI payment, it gets shifted forward into late August. But here's an important heads up because, well, where there's financial news, there's usually also noise. Claims of a fourth stimulus check for seniors are floating around again, often fueled by, AI-generated content, let's be absolutely clear. Any legitimate payments you might get that are being spun as stimulus checks are actually recovery rebate credits. These are for past unpaid economic impact payments from way back in 2020 and 2021. Definitely not a new government handout. Okay, on a more maybe promising note, there are genuinely active discussions happening in Congress right now. They're looking into potential one-time bonus payments or maybe refundable tax credits, possibly up to $1,200, aimed specifically at fixed-income seniors. And that's not just federal talk. Several states, including Arizona, Michigan, and Illinois, are in the final stages of approving their own separate targeted relief checks. We're talking maybe $250 to $500 for low-income households and seniors. Decisions could actually be finalized this very month. And for those of you carefully planning your legacies, there's another big shift we need to cover today. The IRS has rolled out some significant updates to Form 706, that's the U.S. estate tax return. They're streamlining processes, adjusting key thresholds for 2025. So this deep dive will unpack all these financial shifts, help you understand what they mean, and navigate them effectively.
All right, let's get into it. Let's start by really clarifying those Social Security payments, because I know there's a bit of confusion for some folks this month. As we said, over 71 million Americans will get their regular August 2025 Social Security payment. That's standard. But for SSI recipients, there's that unique double payment thing happening, because Labor Day is September 1st. Your September payment gets issued early, specifically on August 29th. So yeah, you'll get your normal August 1st payment and then that early September payment later in the same month. It's just a quirk of the calendar, not a new program. Okay, for everyone else, the standard Social Security payment schedule is holding steady. No changes there. If you started getting benefits before May 1997, your payment usually hits on the first Friday of the month. So for August 2025, that's August 1st. For those who started benefits after May 1997, your payment date is tied to your birth date. If you were born between the 1st and 10th of the month, your payment arrives August 13th. Birthdays between the 11th and 20th, you'll see yours on August 20th. And if your birthday falls between the 21st and 31st, expect your payment on August 27th.
Pretty straightforward.
Right. And if you ever look at your bank account on that scheduled date and the deposit isn't there, the very first step is really simple. Just contact your bank or financial institution directly.
Okay.
Sometimes there's just a slight delay in how they actually post payments to accounts. It happens.
Mm-hmm.
If, after checking with your bank, the money still isn't there, the advice is to wait 3 additional mailing days.
3 days. Got it.
Yeah, before you call the Social Security Administration. Their direct number is 1-800-772-1213. This just helps filter out those common little bank delays before you spend time on hold with the SSA.
Right. Makes sense. Now let's tackle that digital elephant in the room. The persistent fourth stimulus check hoax. It seems to pop up constantly, doesn't it?
It really does.
I saw AARP, which is, a very trusted source for seniors, published an article back in December 2024. They explicitly stated Social Security beneficiaries are not getting a new stimulus check.
Mm-hmm.
So what's driving this endless cycle of misinformation, especially when reputable sources are clearly debunking it?
That's a great question, and it really highlights, a modern challenge. What we're largely seeing is fueled by these things called content farms.
Content farms.
Yeah, they're not your typical news outlets. They're basically operations that churn out dubious articles, often using generative AI, artificial intelligence, to create stuff that sounds plausible but lacks any real factual basis. Their main goal isn't to inform you, it's just to get clicks and ultimately ad revenue. They tend to repeat key phrases, maybe slightly reworded, and almost always lack proper sources. It makes it incredibly hard for the average person to tell fact from fiction.
Wow.
It's a significant hurdle in, well, our current information landscape. And just to be super clear, those legitimate payments that sometimes get misinterpreted, those are the recovery rebate credits.
Right, you mentioned those.
Think of it like the IRS finally catching up on old paperwork. These go out to about 1 million taxpayers who are actually eligible for the original COVID-era economic impact payments, the EIPs, from 2020 or 2021. But for whatever reason, maybe an old address, maybe they didn't file taxes, they just never got them.
Okay.
So it's not a new handout, it's delivering on a past promise. And it really shows the challenge of sorting real financial news from all the online noise.
So basically, when you see a headline promising a new stimulus check, your first reaction should be, well, healthy skepticism. Always check official government sources like irs.gov or ssa.gov or, established reputable news outlets.
Exactly. Always verify.
But while we're debunking, let's pivot back to the genuine discussions about financial relief. You mentioned congressional talks for those one-time bonus payments for seniors, any movement there. And what about those state-level checks?
Absolutely. On the federal side, those discussions are active. We're talking about potential one-time bonus payments or maybe refundable tax credits. Could be up to $1,200 for seniors on fixed incomes. Now, nothing's finalized yet, but it's a real legislative effort, not just a rumor.
Okay, good to know.
And simultaneously, yes, at the state level, places like Arizona, Michigan, Illinois, they are actively considering proposals for targeted relief checks. These are typically smaller, maybe $250 to $500, aimed at low-income households and seniors. Decisions on those could actually be finalized as early as this August, so that could mean tangible relief for specific groups soon.
Right.
So the key takeaway really is, be wary of those vague, sensational claims online, but definitely stay alert for specific, well-defined programs coming from official sources.
That's a really crucial distinction. Okay, so we've cleared up the immediate payment questions and the misinformation flying around. Let's maybe zoom out a bit now to the broader health and future of Social Security itself, starting with a key legislative change that's quietly reshaping benefits for a lot of people. A significant piece of legislation, the Social Security Fairness Act, was signed into law January 5th, 2025. And here's the kicker. Its changes are retroactive back to January 1st, 2024. That seems like a pretty powerful move.
It is indeed a very big deal for many. The significant impact of this new law is that it eliminates both the windfall elimination provision, WEP, and the government pension offset, GPO.
WP and GPO, right.
Exactly. Previously, these provisions, well, they reduced Social Security benefits for people who also got pensions from jobs not covered by Social Security.
Like public sector jobs.
Precisely. Think of many state and local government employees, teachers, firefighters, police officers whose government pensions often weren't part of the Social Security system. For decades, WEP and GPO meant their Social Security benefits were cut, sometimes significantly. So the key takeaway here is that hundreds of thousands of these public sector workers who previously saw those reductions will now receive their full, hard-earned Social Security benefits. It's a huge boost to retirement security for a large group of people, though it's important to note this doesn't affect other pensions, like, say, from CalPERS.
That really is a monumental change for potentially millions of people over time. Now, shifting gears slightly to the Social Security Administration's own fiscal oversight. How well are they managing the money? A press release from the SSA Office of the Inspector General, the OIG, back on May 22nd, 2025, gave us some, well, interesting and maybe somewhat concerning insights. While the SSA apparently made overall progress in fiscal year 2024 on improper payments generally, the OIG found that the supplemental security income, the SSI improper payment rate, actually increased. It went from 9.41% in fiscal year 2019 up to 10.62% in fiscal year 2023. That totals about $6.5 billion in improper payments. That's a staggering amount of money. What's driving that specific challenge with SSI?
Exactly. That $6.5 billion figure really jumps out. And what's particularly illuminating here is the OIG's estimate. They figured the SSA could have prevented roughly $2 billion in overpayments in FY 2023 alone.
$2 billion? How?
If they had just expanded their use of the Access to Financial Institutions program, or AFI.
AFI.
Yeah, Access to Financial Institutions. Currently, SSA uses AFI mostly when processing initial SSI applications and during periodic checkups, called redeterminations. However, the OIG noted that a striking 89%, almost 90% of overpayments that happen because someone has too many resources, like like money in the bank.
Okay.
Those happen due to changes after these initial checks are done.
So after they're already approved.
Precisely. The OIG has actually recommended broader use of AFI before. This really highlights a critical area where the government could be more efficient, prevent these improper payments. It builds on earlier efforts like the Payment Integrity Information Act, or PIAA. That was signed back in 2020 by former President Trump, aiming to cut waste and fraud across government agencies. It's really about using the tools they already have more effectively to protect taxpayer dollars.
That makes perfect sense. It really does sound like having a security system that only monitors the front door, but ignores the back windows, right?
That's a good analogy.
Okay, let's transition now to another crucial area of financial planning. Your legacy and, specifically, estate taxes. We're talking about key updates to IRS Form 706, that's the United States Estate and Generation Skipping Transfer Tax Return. These changes apply specifically for folks who pass away after December 31st, 2024. And this is where it gets really interesting, I think, for anyone managing inheritances or planning for the future.
Indeed. We're seeing some pretty significant inflation adjustments for 2025, and these directly impact, tax calculations and who even needs to file. For instance, the basic exclusion amount, that's the value of an estate exempt from federal estate tax, is now a substantial $13,990,000.
$13.99 million. Wow.
Yeah, it's up quite a bit. The ceiling on special use valuation, which is particularly important for families with farms or closely held businesses, it lets certain property be valued based on its current use, not its highest potential market value. That's now $1,420,000.
Okay.
And the amount for figuring the 2% portion of estate tax payable in installments, that refers to a special low interest rate on part of the tax if paid over time, helpful for estates with illiquid assets, that's risen to $1,900,000. Finally, the basic credit amount itself is now $5,541,800.
So what's the bottom line with all these higher numbers?
The headline here is pretty clear. These increased thresholds mean far fewer estates will actually owe any federal estate tax at all. For many families, this really shifts the focus away from complex tax avoidance strategies towards just ensuring proper documentation for transferring wealth smoothly, especially when planning for portability, which we can talk about.
Right. So effectively, more wealth can pass down without hitting that federal estate tax trigger for a lot more families. That's significant. Now, beyond those dollar amounts, the form itself, Form 706, has apparently undergone a redesign. For efficiency, you said. I understand all its accompanying schedules are now separated from the main form.
That's right.
Plus, some schedules got renamed. Schedule A1 is now Schedule T, and the continuation schedule is Schedule W. What's the practical benefit there for someone filling this out?
Yeah, that's right. Separating the schedules should make organizing the paperwork much clearer. Hopefully, it'll reduce some common filing errors people make. And on the administrative side, there are some other important streamlining efforts. For example, the section where you used to authorize representation. That's actually gone from Form 706 itself.
Oh, so how do you authorize someone now?
Instead, filers have to use the standard forms. Form 2848, that's the power of attorney form, or Form 8821 for tax information authorization. It standardizes the process. There's also a much stronger push towards electronic payments. You'll see direct deposit fields added for refunds, for overpayments, and the main guidance now points users straight to irs.gov payments for paying any tax due. It just reflects that broader government push towards digital efficiency and, frankly, better security in financial transactions.
And here's a specific cost reduction that might interest some listeners. The fee for an estate tax closing letter, an ETCL. It's been reduced to $56. Down from 67 times. That's for requests received on or after May 21st, 2025. A little bit of savings is always welcome, right?
It is, yeah. A small but welcome change.
But what are the new requirements for actually requesting one of those letters?
It is a nice little saving, but the process changed slightly. Requests for an ETCL now must be submitted via pay.gov. That's part of that electronic push again.
Okay, pay.gov.
And executors are advised to wait at least 9 months after filing Form 706 before requesting one. It just gives the IRS enough time to actually process the return.
Makes sense.
More importantly, though, there are new requirements for reporting asset values. This is pretty significant. Estates are now required to file a separate form, Form 8971, alongside Form 706.
Form 8971. What's that for?
This new form reports the estate tax value of each asset, not just to the IRS, but also directly to the person receiving that asset.
To the beneficiary.
Exactly. This is crucial for ensuring consistent basis reporting. It means the person inheriting, say, stock or property, will know its official tax basis. That's vital for figuring out capital gains if they sell it later.
Right. Prevents confusion or discrepancies later on.
Precisely. And failure to file this new Form 8971 can now result in penalties. So it's a really important new compliance step for executors.
That consistent basis reporting definitely sounds like it could prevent a lot of headaches down the road for beneficiaries. Good change. Now let's talk about a specific special rule for portability elections. I know this can get a bit complex. For estates of people dying in 2025, Form 706 must be filed if the executor wants to transfer the deceased spousal unused exclusion, the DSUE, amount to the surviving spouse. And this applies regardless of the estate's size, even if no tax is due. Why is this filing now mandatory just for portability, even for smaller estates?
That's a really crucial point, especially for married couples. This portability election, it essentially lets a surviving spouse inherit any unused portion of their deceased spouse's estate tax exclusion amount. That's the DSUE.
Right, the deceased spousal unused exclusion.
It's a really powerful tool for long-term planning because it effectively doubles the amount a married couple can pass on tax-free over time. The big change for 2025 is that even if an estate is small, well below that $13.99 million threshold, not owing any federal estate tax, if the executor wants to preserve and transfer that unused DSUE amount to the surviving spouse for their future use.
They have to file Form 706.
They must file Form 706 specifically to make that election official. It basically ensures that this really valuable exclusion isn't accidentally lost just because the first estate wasn't taxable. But there's good news here for these portability-only filings. A significant simplification has been introduced.
Easier how?
Well, smaller estates making this election are no longer required to report the detailed value of property that's eligible for marital or charitable deductions on all the individual schedules. Instead, executors can often use an estimated value from a predefined table. It significantly streamlines the filing process just for these specific situations.
Less paperwork if you're only filing for portability.
Exactly. If you connect this to the bigger picture, it sort of shows the IRS trying to balance their need for data with making compliance less burdensome in specific non-taxable situations. They're trying to make it easier for people to claim this important benefit. Also worth noting quickly, there's a new Schedule PC for protective claims for refund. This lets estates preserve the right to a refund for expenses that might become deductible later on, maybe due to litigation or something.
Interesting.
And in a definite nod to our digital age, digital assets, think cryptocurrency, NFTs, etc., are now explicitly included in the definition of the gross estate.
Wow. Okay, we have truly covered a vast landscape today. I mean, from understanding those immediate August payments and, really importantly, debunking that widespread misinformation, to navigating complex Social Security reforms like the end of WEP and GPO and the issues with SSI payments, and finally, diving deep into the pretty intricate details of the estate tax updates for 2025. It's crystal clear that staying informed and being able to tell reliable information from all the online noise is just more crucial than ever, isn't it?
It absolutely is. Today's financial landscape, it really isn't just about what you earn or what you owe anymore. It's increasingly about how well you understand these constantly evolving rules and, just as importantly, how effectively you can cut through that noise of misinformation we talked about.
Right.
So the provocative thought I'd maybe leave you with today is this. How might these ongoing shifts in federal benefits, in Social Security integrity, in tax policy, how might they fundamentally reshape long-term financial planning and asset management for individuals, for families in the coming years? What might your own financial strategy need to look like, say, a decade from now, informed by the kind of rapid changes we've discussed just today?